So it depends on the pool of capital. For example, there were regulations that made money market funds hold more treasuries rather than corporate paper. And that's an example of kind of shoveling people into treasuries. And so we also see that banks, because they're not really lending too much, they've been buying treasuries. They've been net buyers of treasuries on average. And then also you have, insurance funds, for example, have to hold a lot of their float. They're basically they collect premiums and then they pay out claims, and they hold a permanent float. So depending on the insurance company, generally billions or tens of billions of dollars of investable assets, and they basically get to earn the income from that, but they have to keep it super safe. And so some insurance companies are 100% bonds, and they might do mostly government bonds, but then also some municipal bonds and some corporate bonds. And then you have a handful of them that can put some of it into equity. So, for example, Berkshire Hathaway, Warren Buffett's company, does that. I also know that Cincinnati Financial, for example, does that. There's some insurance companies that venture out. We've also seen actually a trend of some insurance companies buying Bitcoin. That's been one of NYDIG's big kind of approaches. But overall, insurance companies are very, very bond heavy because they have to. They have to match those. They have to have basically low volatility and match their liabilities to their expected payouts. So a lot of this is mandated. But then you see, there are pools of capital that have some more flexibility, and then they go out on the risk curve trying to get more yield, and that does come with risk. And so, for example, pension funds, they target like 7 or 8% returns, which is hard to do when historically they've been bond heavy portfolios, and bonds used to yield 5-6%. So you had bonds, you had equities, and you could make 8, 9, 10%. But now with bonds so low, they've been allocating elsewhere. So they go into private equity. They go into some leverage things. We saw, for example, that California's pension, they actually levered up a little bit. They basically levered up 5% of the portfolio to buy some of their riskier assets. They kind of increased their risky exposure, and that's an example of these pools of capital that have some flexibility being pushed out on the risk curve, because instead of just having some of their portfolio in super safe assets, they increasingly want to go into these other areas because they have certain targets that they have to reach. And so it's a really problematic environment. It's kind of like when you squeeze all the juice out of the orange. We've propped up asset prices so high that now we're starting to see kind of improper behavior as people would say, well, I can't own bonds, so I have to own riskier things. And then they deal with that volatility. Pretty much. I think there's a variety of reasons. And this has been one of my core themes going into this year, is the idea of financial repression. So high inflation, but not correspondingly high interest rates. And I often use that comparison to the 1940s that we discussed before, because that was the big difference between the 40s and the 70s, is that, in the 70s you had high inflation, but you had high rates as well, whereas in the 40s you had high inflation without high rates.
Right.
Because a lot of the current situation looks like the 40s, we're basically at a financially repressed environment. So we have this high inflation rate, but central banks are still holding their short interest rates low, at zero roughly, and then long duration rates, they buy a lot of those bonds to take off excess supply from the market. They create collateral shortages. And so you have this situation of, positive yield curves in many environments, but very, very low, suppressed well below the inflation rate. And the interesting thing is you even see junk bonds on average now have a negative real yield, which is I think might be the first time in modern history where you're not even getting fully compensated. Now, some of this is because of mandates. There are large pools of capital that have to buy bonds. They're regulated too. And then also, there are still institutions that believe it'll be transitory and that believe that it'll kind of normalize. Then you have retirees and things like that they're not mandated to own bonds, but they would, maybe they're 80 years old and they would feel uncomfortable being 100% in equities and be exposed to that volatility. So they'd rather have part of the portfolio lose money slowly than have 100% of it in equity. So it's across the board, different reasons. But I would say, yeah, we're certainly in a period of financial oppression where bonds are probably going to have negative real yields for most of the time going forward for quite a while. There's different types. So the simplest one is simply that they own more equities, right? So they just have exposure to equities, which of course can have large drawdowns, compared to bonds. Then the other options are they can go into private equity, so less liquid investments, things that they can't necessarily cash out quickly, but they expect to do good returns over 10 years, which they might or may not get. Then they can also get into corporate financing. So in addition to just buying some, say, safe corporate bonds, they can also go into funding bank loans and other types of financing for firms that are, might not be investment grade, so junk bonds essentially, and junk loans. Then they can go into like levered products where you borrow a little bit, but then you lend at a higher rate with some credit risk. They can buy emerging market bonds as well, so that's a source of higher yield with more risk. And then it's kind of just those different types of things. So either loans, equities, or just different types of riskier bonds. And that's the overall risk, is that they go into things that have more probability of permanent capital loss in a nominal sense, and also more volatility, so they can have a 20% downturn in a portfolio that is supposed to be pretty safe. So you can imagine, for example, an 80-year-old might not want to be 100% in equities. They might not want to be exposed to the possibility of a 40% downturn in a year. And traditionally, they've been advised to have more bonds exposure, but with bonds being such a bad investment, they find themselves between a rock and a hard place, and then they often want to buy, more equities. And so I think it makes sense in some ways, but it does come with risk. Yeah, they can buy Bitcoin, and that's something I've been advising since 2020. That people have different numbers for how much Bitcoin's right for them, but zero is not the right number for most people anymore. And so for obviously some people, super high conviction, they don't want to own anything other than Bitcoin, and they're willing to accept crazy drawdowns and crazy doublings and triplings in price. Whereas obviously other investors with maybe less conviction or less volatility tolerance, for them it's putting Bitcoin as some non-zero position in their assets. So they might take some of their bonds and put it in Bitcoin. So even if you have part of your portfolio is a melting low volatility ice cube, you have this other part that over the next 5 years, hopefully rapidly appreciating in price and kind of balancing some of that out. So you have kind of that mix of low volatility without necessarily losing value. So there are different strategies like that. I do think more of them should probably turn to Bitcoin. We've seen some pensions get into Bitcoin, but they've been somewhat slow. They preferred, I guess, more levered kind of Wall Street products than Bitcoin so far. But I do think overall the Bitcoin would be a better choice.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information, and it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much, much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really, really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.